Hello everyone and Happy New Year. It is Thursday, January the 7th, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my most important charts and data series that I'm focusing on this week. Number one, let's look at some price activity in the S&P 500. We had a breakout from a couple of months of sideways congestion at the beginning of November. It's not quite hit its target of 38.50. Let's take a look. We actually talked about this pattern on the last Your Daily 5 that I did. That was back in November. And what we were looking at that time was after a couple of months of sideways investor indecision that's highlighted here in pink, there were four moves here back to back that were about 10% each, starting with the move down from the September 2nd high. We finally had a breakout on November the 9th. I call that one Pfizer Monday. That was the Monday following the weekend news that Pfizer had a vaccine with very high efficacy, and the market opened a ton higher. I think it was like 100 higher, the S&P 500. It fell back to the lows of the day that day, but it still stayed up above the triangle. And that target stays at 38.50. That's about 100 points or 3% higher than where we are right now. And up above there is 4,000. 4,000 is psychological resistance. The stock market loves big fat numbers, especially when it's up in new territory as it is right now. So when I look at this and say, ask myself, how much farther can this thing go? It's come a long way really quickly. I'm looking at this 38.50 to 4,000 area as a likely expectation as long as market internals stay strong, and we will get to those in just a moment. But right now we're looking at 38.50 for our target. And let's go to our next slide. The NASDAQ Composite Index, we had a similar breakout there on November the 16th. Also another chart that was from the last Your Daily 5 that I did back in November. Target's 13,300. You can see you've effectively got the same pattern here. We peaked on September 2nd. Then we had a lot of back and forth here that indicated the market was taking a breather. It wasn't quite sure if it should continue to go higher, if this was a place to sell, and there was just a lot of back and forth here. Now, unlike the S&P 500, which broke out on the 9th, you can see there was a failed breakout on the 9th here, fell back into the pattern, so we didn't get our breakout here until November 16th. The important takeaway there is, in our view, a lot of the reason that the stock market in general stalled throughout September and October was because tech stopped leading. Usually in a healthy bull market, in a sustainable bull market, you get tech leading. It didn't lead this time up until we got into the end of November. Then you started to see tech lead again. Let's back up a step. We've got a target here of 13,300. That's about 4% higher than where the market's trading right now. But since December the 22nd, tech has started to underperform. What I mean by that is the comp is starting to underperform SPX. So that doesn't mean they both can't go higher and hit their targets, but this underperformance since the end of December, I'm looking at as a potential early indication that the market is starting to get a little bit over its skis here, and we could see a pullback soon. Number three, market internals, the Asbury 6. Those that have been seeing my videos here for Your Daily 5 know that the Asbury 6 is an in-house model that we use to determine the daily health of the U.S. stock market. I think of it as a trip to the doctor for the stock market. As we get older and we go to the doctor more, there are a series of steps the doctor does. The first thing after he sees you, takes your blood pressure, checks your temperature. He may listen to your heart and lungs. This is what the Asbury 6 is meant to be. We have back tested this, and we found 6 indicators that work very well with each other. And what I mean by that is every indicator has an Achilles heel. There is no favorite indicator that we have here. So we found 6 indicators that are diverse enough that when one indicator's Achilles heel shows up and he gives a false signal, the other 5 will pick it up. Only one of the 6 here, by the way, has to do with price, the rate of change in the S&P 500. The other 5, by design, are not based on price, because price can be very deceiving these days with all the algorithmic trading going on. Most of the volume day to day is algos. So we're looking at what I would call secondary indicators, market breadth, trading volume, bond spreads, asset flows, to try to be a lie detector for the market. So the Asbury 6 turned positive on November the 4th. Our sister model, the correction protection model, or CPM, flipped to risk on a day later on November the 5th. As long as these metrics are telling me risk on, despite the fact the market is way out over its skis and it's overdue for a correction, we're still going to stay long. These models help to keep us in the market when everyone is nervous the market is too high. These keep us focused on the day-to-day health of the market, and the day-to-day health of the market right now is good. One thing, though, I want to point out, sometimes we'll see the Asbury 6 start to blink, and by blink means you'll get 1 or 2 of these that will turn negative, and they would be seen in this column here, and they would be red. All of these are the dates that each of these 6 constituents turned positive. We have a lot of blinking that's been going on for the past month. In other words, a couple will turn negative and then they'll go back to positive. I see that as a precursor to some kind of a corrective move coming down the pike. So again, it's too early to sell. As long as our models stay risk on, we're going to be in the market, and we have been since the beginning of November. But this blinking that's been going on in the A6 is a little bit of a concern that we're watching very closely. Number 4, sector asset flows. Financials and energy are attracting the money. This is another in-house model that I wanted to introduce you to. And what this does is looks at the 11 sector spiders, and it measures the percentage change of asset flows over the past week, over the past month, which is our tactical time period, and over the past quarter, which is our strategic time period. Currently, asset flows, the biggest positive percent change of asset flows are going into energy, as you can see here, green all the way across, and financials, green all the way across. The assets are coming from utilities and industrials. What does that mean? It means to look for outperformance, to look for value in the energy and financial space. Both of these have given us a signal. This is called our CEF model. Our CEF model had overweight signals in financials and energy since November the 12th. Since that time, XLF has outperformed the S&P 500 by 9.3%. XLE, or the energy sector spider, has outperformed by 17.4%. So we use this to not only, after we have our risk-on signals from our models, the next question is, where do you want to be? So as long as money keeps going into energy and financials, we are overweight those, and we're actually looking for individual stocks in those sectors. Finally, you got to keep an eye on seasonality right now. The S&P 500 is about 16 or 17% above its 200-day moving average. It's vulnerable to a pullback. So this is the times that we like to look at seasonality. This is a quarterly seasonality chart in the S&P 500 going back to 1957. So these 13 bars here are the 13 weeks of the first quarter. January is highlighted in green. The first week of the year and of the quarter is the second strongest of the entire quarter, after which you start to see this deteriorate. Seasonality deteriorates really until we start getting into March. So again, we are still bullish. We have been risk on since the beginning of November, but you need to be aware of seasonality and you need to watch market internals, things like market breadth, asset flows, to make sure that you see the market weakening and are out of here and book some profits before we get a correction, which we think that we're going to have a little later this quarter. So that's your Daily 5 for today. Thanks for watching. See you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.